Thank you very much. So we have Ellis from BVI Finance Limited. Ellis is the Chief Executive Officer of BVI Finance and brings to the role wide-ranging work experience in Asia, North America, the Caribbean, and Africa. Ellis has played a major role in expanding and deepening the BVI's financial services footprint in cities around the world, specifically in Asia-Pacific region through strategic relationship building, conducting forums and seminars
any specific order
on the BVI's financial services.
Mic's on.
Including at major financial institutions. She previously served as a director and Asia-Pacific representative at BVI House Asia, EU-UK representative and director of the BVI London office, and at BVI International Affairs Secretariat, BVI Financial Services Commission, and BVI International Finance Center. So, I mean, there's a lot of, roles she's played at BVI, so I will be passing the mic to her to moderate this panel session.
Good morning. Thank you for joining us for this panel discussion on Destination Digital, African Global Hubs Alive, Fintech C-Suite Priorities and the IFC Advantage. As she said, I am Elise Donovan from BVI Finance. BVI is an international business and finance center where we offer a number of products and services in the international financial services arena. I am joined today by a group of very esteemed and esteemed panelists who have a number of years' experience across the field of international finance. I'm going to let them introduce themselves, so I'll start with Tom.
Hello, good morning everybody. So I am at Harney's and I lead Harney's non-contentious investment funds practice in London. I also do a lot of corporate work as well. And I've got, in terms of my client base, a strong client base in Africa, as well as across the Middle East and Asia.
Good morning, my name is Eric Flay. I'm a partner at Conyers, Dillon Pearman. I head up our London office. My practice is in investment funds, financial services, regulatory, and also digital asset fintech work.
Morning, everybody. My name is Jeff Kirk. I'm the managing partner of Appleby, BVI. Head up the corporate team, a large part of which is in relation to the fintech sector. Thank you.
Okay. Tom, you want to go again, and Eric, because I think only...
Happy to go again. Yep. So I lead Harney's non-contentious investment funds practice in London. I also have a strong corporate practice and clients predominantly based in Africa, but also the Middle East and Asia.
I'm a partner in our investment funds, fintech, and financial services regulatory practice, and I head up our London office of Conyers here in London.
Okay. So we're going to be talking today about Destination Digital. A new generation of businesses is shaping the financial services industry in Africa, whether it be Artel Money plans for 4 billion IPO Nigeria's Money Point achieving unicorn status. Fintech businesses are gaining significant momentum across the region, driven by rapid technological advancement and shifting consumer and business expectations. In fact, in 2024, there were 1,250 active companies compared to 450 just 4 years prior, while African fintech startups raised $1 billion. We BVI Finance, we previously published a report, Destination Digital. We had Consensus, which is a survey company based out of London, do a report on fintech destinations across the world, and it was China, Hong Kong, Singapore, Mexico, the UK, and the United States. And they surveyed 451 fintech executives to find out what were their strategic priorities and what was the global outlook of the play for fintech businesses. We decided to do a specific report that looks at the African fintech market and its growing influence. And we published this report recently, and it looked at over 200 fintech business leaders in Kenya, South Africa, and Nigeria. And this is what we'll be discussing today in this panel discussion. Sorry, I'm pulling up my notes. So the study showed that 96% of African fintechs view cross-border expansion as crucial. Nigeria showed 100%, South Africa 97%, and Kenya were 92%. I'm going to ask my panelists, what's driving this urgency? This is a bit bigger than the global fintech survey, which showed that 94% of fintech executives view cross-border as important. And where do you see IFC's role, International Finance Center, as meaningful in this cross-border expansion that fintech executives determined that were their priorities?
Elise, if I can start. Morning, everybody. I think first point to note is in the context of the sector itself. Digital assets, platforms, DeFi, crypto exchanges, the very nature of the product or the service is global in its outlook. It's not, these are not domestic products. These are not geared towards specific jurisdictions. So we see it not just in relation to Africa offerings, but globally. You want your product, you want your tokens, you want your crypto to go out globally. And that's why I think the cross-border aspect is crucial. I don't think any of us will be surprised by that. We certainly will see it in the developed markets, you know, the American markets looking to expand its offering. I think the one sort of difference in specifically Africa is that you need to have and you need to grow your investor base. That is growing as time goes on, but in order to, you know, if you were just going to focus on one jurisdiction at a time, it would be very difficult. So as a natural reaction to that, any founders of products, of tokens, are looking to go on a cross-border basis. They want to try and get their products and get their services out as far as possible. So in that sense, I think it's a natural reaction that the cross-border aspects of it. You mentioned Nigeria, 100% agreement with a concept. South Africa, 97%. You know, any founders want to ensure that their offering is offered as broad as possibly. The broader it's offered, the more likely that success will result. The question then is structuring. Where do you set up? Are you going to do a token issuance company? Do you do it in the domestic jurisdiction? Or do you look more to the international sector? And that's where the IFCs, the international financial centers, come into play. You know, we'll see, you look at a lot of the cryptocurrency exchanges, you know, where are they incorporated? BVI, well, you know, we hold a lot of them. But it's a general offering, and I think that's a crucial aspect of it. You have to be international in your outlook, and then the question arises, which jurisdiction? And you really have to identify the right jurisdiction and the right structure.
think also just to supplement, so Jeff was speaking about the product and the users, there's also a significant cross-border element when it comes to fundraising. So a lot of the capital that goes into these startup businesses is venture capital in nature. It often, not exclusively, but a significant portion of that capital comes from North America, unsurprisingly. So there's also a very significant cross-border element on the capital raising side of these businesses. It's fair to say that these are fairly niche, high-risk strategies. Not all VCs have the capital and the risk tolerance to invest in these sorts of businesses. So in order to sort of maximize your prospects of being able to raise capital successfully, often you almost by necessity have to do it on a cross-border basis.
Okay. The commentary in the report showed that the young, the underbanked, the mobile money base and currency pressures, how are these shaping the product roadmaps to scale beyond markets?
Well, yeah, I mean, in Africa, in terms of unbanked clients, I think it's the highest percentage in the world.
Yes.
And that is really a crucial, there's a niche market there, there's opportunities there. And we're seeing it. I think, 50% of all global online banking or phone banking is done through Africa. So there's a huge demand for it, and where there's a huge demand, there's a huge opportunity.
Okay. Speed to market is essential, but must be tempered with risk controls. What's the playbook for balancing velocity with governance so deals don't die? And this takes into consideration the need to build compliance when you're starting up these types of businesses.
Yeah, I mean, this is tricky. We have a lot of startup clients that come with sort of burgeoning businesses, good ideas and prospects. Part of our role, of course, is to advise them to be, mindful of compliance obligations. Sometimes it can be very difficult to retrofit compliance infrastructure sort of after the fact. So if you launch too quickly to market, you may find it quite difficult to kind of catch up from a compliance perspective. I think something of great promise we've seen in the market more recently is that compliance offerings have become more efficient. It's easier to outsource compliance to reputable service providers. And the increased use of AI, particularly in compliance offerings, makes the product suite is more attractive and it's more efficient. And it enables startup clients to build in at least some basic compliance infrastructure, or at least the framework for future compliance upfront without significant CapEx investment.
Eric, can you just explain what type of compliance we're talking about?
Yeah, sure. I mean, it depends on the nature of the business, but like data protection is a big issue. If you just start launching a business and collecting, personal data and not dealing with an appropriate manner, it can be quite difficult to kind of catch up after the fact. Obviously, other issues such as, KYC, sanctions compliance is a big one. But there's a lot of, reg tech-driven solutions in this sector now that enable clients to kind of get ahead or at least build in a kind of base level of compliance infrastructure, even at a fairly sort of early stage startup phase of the business.
Okay.
Yeah, if I can just add to that as well, I think, we saw a real boom from sort of 2016 onwards. And in those, as has been the case to today, the sort of compliance regulatory aspect has come on afterwards as the jurisdictions have had to almost catch up. But a large part in our jurisdiction has been the service providers recognizing where the end road would be. And I know, we would often have clients dating back to 2017 looking to issue tokens. And strictly speaking, there wouldn't have been AML requirements in those days. They weren't caught by the securities legislation or indeed any other regulatory regime. And what this meant, but it was almost inevitable that AML requirements would apply. If you're issuing tokens and you don't collect an AML and KYC up front, what that would mean would be 5-6 years down the line, it would be an impossibility to collect it. So I think the service providers, in terms of protecting their jurisdictions, did the right thing by saying, look, this is an inevitability. You're going to have to start collecting it. If you don't do it now, it's going to be an impossibility to do it 5-6 years down the line. And if that then happens, those requirements come into place, you're going to be non-compliant, and you're going to be in breach of AML laws at that point in time. So it was really important that they start collecting the data and the KYC at that point in time. And to be fair, most recognized that and most did that. And that has created a sort of bedrock of compliance over the years. And it's becoming more, and obviously nowadays with the regulatory regimes in place, that's an absolute requirement. There's no escaping that.
I completely agree. And things like, geofencing is now, it's commonplace, but, years back it wasn't. But it's often clients like building in some of those compliance kind of guardrails and controls up front, even if they don't necessarily implement or exercise the controls, but having them in place. With DAOs, decentralized autonomous organizations, obviously the appeal there is pure decentralization, but it creates very, very significant regulatory risks if the holders of tokens, for example, can modify a protocol in a way that puts the entire project into regulatory breach. So it's building in those sorts of guardrails and controls up front that's really important.
And just a little bit to be mindful, we're assuming everybody knows our acronyms: anti-money laundering, know your customer, KYC, so just...
Client due diligence.
Yes, client due diligence.
I was just going to add that when it comes to the AML regimes in the IFCs, and that what the IFCs try to do is take a balanced approach and what we call a risk-based approach. So there is it builds in some flexibility, which again tries to enable deals not to die in the due diligence, as it were, and to try and create a regime which is flexible and workable, as well as being robust.
Okay. With 39% of the survey respondents cited ESG, environmental, social governance solutions, as a strategic focus, what are credible near-term ESG use cases that also attract institutional capital? So how can we attract capital with ESG solutions?
Yes, I mean, ESG is a really topical issue nowadays, and rightly so. I mean, we've seen in terms of climate issues, governance issues, it's coming a lot more to the fore. And investors are demanding compliance with ESG requirements. And, that then builds in your disclosures and measurements in relation to that. And a reputational risk aspect as well, because you cannot hold yourself out as an ESG or a green fund, and then subsequently you're not meeting those requirements. So I think that's something where it is becoming more to the fore. It's probably more investor-driven, well, in terms than the products or investment opportunities that arise. But it's certainly something that you cannot ignore. We see it, in the Caribbean IFCs often. We always talk about the green economy, but we're seeing a lot of movement to the blue economy. In terms of the maritime issues, the coral issues, in terms of how can we invest in profitable opportunities that are going to feed back and positive outcomes into the community. In the African context, I mean, that's becoming more to the fore, and you can see that you cannot afford, as a offering, to invest in or be seen as just extracting value without adding any positive input back in. I think it's something that investors look at very closely. So I think that's becoming a really important aspect in the future.
In the three markets that we surveyed, South Africa, Nigeria, and Kenya, they obviously have different regulatory standards. How do you harmonize standards across markets?
Can I just go back to ESG just for a moment? That's all right. I agree with everything Jeff said. I was coincidentally speaking to a Nigerian fund manager client of mine yesterday, and I've recently launched the fourth Africa-focused fund with them, and I aware that they had an ESG policy as part of their investment strategies. And I was talking to our clients, and he was explaining that, yes, this is investor-driven. They have one seed institutional investor that's invested into each of their 4 funds, their 4 main funds, and that 10 years ago when they launched their first one, there was no ESG in their investment strategies, but now it's very much part of, it's become very much part of their core investment strategies. So yes, I'd say investor-driven. I've also got other funds clients who the managers is also wanting and trying to do the right thing in terms of moral standing with ESG issues, but predominantly investor-driven, I'd say.
It's often you'd see that ESG considerations, it's not a hard and fast rule, but the larger the fund, the more capital you're looking to raise, the more likely it is that investors will be demanding ESG considerations. For very smaller startup, venture capital, fundraising, it's less commonly cited as a major issue, but that said, if you don't build in ESG considerations up front, it could effectively put a cap on your future capital raising ambitions. So you don't have to do it sooner or later, and we've encouraged the clients to consider it sort of from inception.
And no greenwashing.
Mm-hmm.
No greenwashing. And I think it's also, in the Africa context, it's you really cannot be seen to be not putting anything back, whether it's diversity. Oftentimes, if you look at tokenization, real-world assets, could be minerals, anything of that nature, diamonds, gold, that's becoming to the fore now. You want to make sure that if you're offering that, you're doing it in an environmentally sustainable way, and at the same time ensuring that local communities are part of the growth and benefit from the wealth that's created.
Okay, so ESG is definitely a requirement. Moving back to the other question about regarding the 3 markets and trying to harmonize across borders, how do you achieve that?
With a degree of difficulty. No, these are problems. It's not limited to fintech at all. We see it, across in terms of funds, equities. How do you go to market? How do you offer this on a, to quote the European EU mechanism, a passporting basis? I think a large part of it, you've got to look, and again, it comes back to that initial work, identifying the right jurisdiction to set up in. Why the right jurisdiction? You want to see if there's any opportunities that can be used for cross-border distribution and provision of services and products. If you look at it, this is such a new area as well. The regulatory regimes are just a few years old. And everybody's monitoring everybody else to see what differences will apply and where to draw an advantage. Now, by way of example, and I'm going to go back to token issuances, certain jurisdictions will insist that's a regulated activity and you must then be registered as a VASP or a CASP. Other jurisdictions don't require that. So that would be a first instance. Look at what you're looking to do and what jurisdiction best suits for you to do that. In terms of the 3 jurisdictions, South Africa and Nigeria and Kenya, I think it's a case of you really, once you've set up, if you're setting up in an IFC, you're going to then still have to do that groundwork to say what's it going to take, what licensing regime am I going to need to offer this in these jurisdictions. And oftentimes we'll see, the white papers involved will restrict the jurisdictions because sometimes you'll say, well, you'll know the US market is quite restrictive. You've got to be licensed. So it's made very clear we're not going to be offering in the US market or South Korea or Japan, wherever it might be, where it's very clear it's going to be difficult. So I think what that's going to take is you're going to need international legal counsel to advise you on those specific jurisdictions you're looking to get into.
Okay. Another consideration is that a significant percentage of the survey respondents also said, with half of them cited sanctions, access to finance as most impactful, and followed by trade tensions. Of course, we're in a trade war, and political instability. How can structuring choices, whether it be treasury, multi-currency, SPVs, and banking, help to mitigate those risks, whether it be sanctions or the trade barriers or political instability?
Okay. I think that, again, you're going to need to identify which jurisdictions are best suited for you to do that. In a part, you mentioned tariffs, sanctions. Sanctions is a global issue. I mean, that's really something that none of us can escape, or if you don't want to escape it, it's at your peril. But I think there are other aspects to that. The tariff issues, again, that means you'll look at specific jurisdictions and say, well, what is the US tariffs that are going to be applicable to that? And nowadays, it's not only the US tariffs, it's any counter tariffs that might be introduced by other states. So again, it really revolves around doing your research and identifying where is going to work best for you. And you've got to counter that as well with sort of systemic issues we've seen in Africa generally, the exchange control limitations. You don't want to be in a position where your clients or your investors are going to have issues in terms of repatriating their investment at one point in time. So there's a lot of different factors, and it really boils down again to making sure you identify the right jurisdiction up front. That then correlates, you've got this sort of conflicting demand of speed to market. Invariably, our clients want to set up within weeks. But you still need to say, and it's almost the case, well, they'll give us a call and say, where do we set up? Which is the best jurisdiction? Choose it, tell us, and then let's go. And oftentimes it'll be, well, what are you looking to do after that? You've got to get it right up front. Otherwise, the difficulties will flow long stream.
Okay. 72%, Jeff, you just mentioned that setting up in an IFC sometimes takes weeks, but 72% of African fintechs say they already incorporated in IFCs. 19% are considering it. And what are the 2 or 3 biggest misconceptions you will hear about international finance centers, and what does the data actually show?
Yeah.
So one of the big misconceptions, or rather taglines we constantly hear is tax havens, and that's in our line of work a complete misnomer, and we prefer to talk about being tax neutral, because sometimes clients will come to us and say, well, I don't have to pay any tax because I'm setting up an IFC. Well, actually, that when you're looking at the whole structure, that's not true. You're paying tax at the operating level, and shareholders are paying tax at the top level, wherever they're resident, dividends, withholding. And so one of the fundamental concepts of setting up an IFC is to have what's normally the investor level completely tax neutral. So and then leave the more in a secure jurisdiction, leaving the more risky underlying business in a whether it's an African jurisdiction or otherwise, but at least at the top level, it's a secure, robust statutory and regulatory regime in the IFCs, and certainly the British Overseas Territories are based on English common law, and so they have the courts, the English courts behind them. The highest court of appeal is the Privy Council in the UK, where the judges that sit on it are the same judges that sit in the UK Supreme Court.
So you have that legal certainty in terms of any disputes that arise.
Exactly.
I think one of the common misconceptions is we talked about harmonization. But it's not the case that you can set up a holding structure in an IFC and then just ignore local regulatory requirements, in this case, in the relevant African countries. So effectively, you end up potentially incorporating a holding company offshore for capital raising, perhaps for token issuance or other purposes. Perhaps you apply for a VASP license. But inevitably, you still have to comply, or you almost invariably have to comply with local requirements as well. You should think of it in the same way. If a company is raising capital in a particular jurisdiction by way of issuing debt or equity securities, you usually have to comply with the local securities laws in the relevant jurisdiction. Similar considerations apply in the fintech context. So I think that is a misconception. IFCs, they serve a very sort of valuable purpose in terms of adding flexibility, in particular in a tax-neutral platform at the top level of the structure, but it does not eliminate the requirement to work closely with local counsel in the relevant jurisdictions to ensure local regulatory compliance.
And it also does not eliminate your tax liability in the particular jurisdiction.
Exactly.
As Tom was saying, that tax neutrality just means you don't add an additional layer of tax in the transaction.
Yeah, I mean, I couldn't agree more with Tom and Eric. And I mean, I suppose by way of example, you know, we'll often look at setting up a structure. And that structure will be perhaps the ultimate holding entity and the investment vehicle through which international investors can invest. And that might be Cayman, BVI, wherever. If there's a financing aspect to that, oftentimes the financing entities, the lenders will say, well, we want to be certain that our investment or that our lending amount is adequately secured. We are confident that in this jurisdiction, we have greater security because the regime, and I'll use BVI as an example, we offer a public and private registration regime for security interests, whereby if it's publicly registered on the registry, that ensures your priority interest. Very simple basis, first registered, first priority. And that gives lenders a great deal of comfort. And that's one of the reasons why the BVI is chosen so much as a lending jurisdiction. However, if you're looking then into investment into Africa, you will oftentimes see a subsidiary that's incorporated via Mauritius. Why via Mauritius? Because Mauritius has over 120 asset protection treaties in place by virtue of being a member of SADC. Therefore, what are the big risks involved in Africa? Oftentimes it's political risk, expropriation issues, things of that. If you have treaties in place guaranteeing your asset protection, your clients and the investors will feel a lot more secure in terms of that investment, whatever it might be. So it's very much it's not a one vehicle, one jurisdiction approach. You have to structure it for the purposes of the specific investment. And then again, let's say, for instance, and I'll use the example of a BVI holdco for the investors and a Mauritius direct investment entity investing into Africa, and let's say that may be focused at telecoms in Kenya. You will incorporate a Kenyan vehicle, and that Kenyan vehicle will be taxed. It will be subject to corporate tax in Kenya. Then, as the dividends flow through, it'll flow through Mauritius back up to BVI and then be distributed to the investors. That distribution has been taxed. It's not tax-free. There's oftentimes a misunderstanding in relation to it. And I'll come back again. I mean, we see over 120, 130 IFCs around the world, of which I think is about 20 or 30 are OFCs, offshore financial centers. That is growing. You know, we're seeing it, Rwanda IFC. I know for a fact that there's another IFC launching in Africa probably in the new year. So it's the negative connotations that we get about, oh, you're tax haven, don't apply. The funds have been taxed, and they are taxed in that jurisdiction in which the operations are taking place. What we do and what IFCs do is they facilitate that international trade. They facilitate that international investment and operation by, yes, using treaties in place, asset protection treaties, double taxation treaties. to minimize that tax where possible. And that's the real advantage. It's not the tax issues that you know, the tax efficiency. Yes, that's certainly an advantage, but it's not the reason of investing through those structures.
It's also the accessibility to professional networks. Can you expand on that? BVI, for example, has multiple international law firms and corporate service providers which have offices. Some of them have offices in 100 or more jurisdictions. And many of you have offices, you know, Appleby have offices in multiple jurisdictions. So does Conyers, and so does Harney's. Can you talk about the professional global expertise that's available in an international finance center like the BVI?
Yeah, so you're absolutely right. Our three law firms are global firms, and we have very good quality lawyers across the board. And then there's the accountancy firms as well, the tax advisory firms. And in my space, fund administrators. There's all the top service providers to corporates are based in the IFCs, and so it becomes a sort of virtuous circle, as it were. Everyone working together and working in a sort of high quality advisory environment, and yes.
Yeah, no, I'd absolutely agree with that. I mean, it's crucial, and I'm sure all of you are aware that there's nothing more frustrating than having a service provider, setting up a company. You know, you may have independent directors, you may have trustees, companies involved if you're setting up foundations, and you can't get hold of your service provider. You know, there's nothing that's going to ruin your experience faster than that kind of negative experience. So it's something that all of us, and yes, we are competitors in terms of our firms, but we are also aligned in the sense of promoting and protecting the jurisdictions out of which we operate. And that's a very key part of it. You know, if there are issues, we want to address those. And likewise, I think one of the other advantages that the IFCs have are that we have bodies such as BVI Finance that go out and promote on our behalf and on the financial industry sector's behalf. You know, another unique advantage is that, unlike in the very large jurisdictions, you don't have necessarily that one-on-one contact. You can't necessarily, you know, pick up the phone to speak to the head of the regulator, or to the government directly, or to the Attorney General in terms of drafting new legislation. We have that opportunity, either directly or through organizations like BVI Finance, to lobby government. And we've done this in the past. A great example is in the funds industry. You know, we had a 1996 Partnership Act, which wasn't really suited for purpose. You know, 7 law firms, including all 3 of ours, got together and said, look, we really need this. We can't offer our clients the structure they need in terms of the private equity closed-ended funds without an updated Limited Partnership Act. We got together, and, you know, representatives of all 3 of our firms, together with another 4 firms, sat down and worked for about a year, together with a professional draftsman, preparing a Limited Partnership Act, which we then took to government. And we said, look, this is something that we've developed, we've drafted, take a look at it. You know, we think, and we've looked at all the other jurisdictions, we think this is the best in market. We've adopted all the idiosyncrasies and the benefits that we see in other jurisdictions. Limited Partnership Act, I mean, a great example of which is the ability to choose whether to have separate legal personality or not. And we presented that to government. Government reviewed it, and it obviously goes through the House of Assembly and the review process, and promulgated that in 2017. And now we have a very modern, very effective Limited Partnership Act that we can go to market, and, you know, private equity can use and do use now. So that gives us a real sort of unique advantage. Yes, we're small, But because we're small, we have that ability to influence one another, and our communication's quite effective.
So how do we meet the needs of what we're talking about, the fintech virtual asset businesses? You can talk about the vast legislation and what it does, or...
I think in this sector in particular, a sort of standard playbook is we receive, particularly with new clients, you receive this sort of dreaded email saying, from a client saying, I want this, how much will it cost, how long will it take? The thing with fintech, in my experience, is that because the regulations are really quite new, and they are, like, nuanced technical analysis is often required to ascertain specifically what is the client doing, like what is the business model, how does that fit into the regulatory frameworks, and what kind of license may potentially be required. Because speed to market, of course, is critical. It's in probably no other sector is it more important than fintech. But at the one end of the spectrum, if the client is launching a business using an IFC and it falls outside the regulatory net, we could often incorporate that structure for a client within days. At the other end of the spectrum, if they're conducting a VASP, a virtual asset service provider business, it would take many, many, many months and a very significant capital investment to get that license. So the regulatory analysis is critical. Like, that's where we really start. I think aside from the actual licensing issues, I mean, a key thing I always do with my clients is to try and bake in structural flexibility up front. And the regulations change quite rapidly in this space in many jurisdictions, including the IFCs. It's never necessarily clear at inception that the structure that you put in place on day one for a client, I wouldn't view it as evergreen. It's almost invariably going to have to change over time. So I always sort of approach this in terms of trying to create vehicles that are as flexible as possible. And sometimes that can involve creating new entities, but it can also potentially involve, moving a structure from one jurisdiction to another. I think having that additional layer of sort of built-in structural flexibility is critical in this particular sector.
Okay, the bell has rung, but I just wanted to tie up and try to link more closely. The BVI as a jurisdiction facilitates 1.4 trillion in investments globally, and a significant percentage of that investment, or the beneficial owners, is China. China represents 44% of the beneficial owners of BVI business companies. And as we know, China is the largest investor in the continent, in Africa. How can you talk about the synergy or the symbiotic relationship between China investment in Africa and China use of BVI structures, and particularly bring into the fintech space as well, to end this discussion?
Well, I think, from my perspective, Elise, as you said, there's always been quite a close relationship between Asia and the BVI. I spent many years out in Hong Kong, and it was quite funny because, I'd get approached and say, well, I need a BVI, which means I need an offshore vehicle. On occasion, I have been asked for a Cayman BVI. But what that means is you've got an established trust in the jurisdiction, particularly with the Chinese clients. And in terms of, as I was talking about earlier, with an investment vehicle, perhaps at a higher level, they trust and they know that BVI will suit their purposes for protection of their investment. So I think that's a crucial part in terms of the investor side. In terms then of tying that with fintech, we are seeing more and more opportunities and products being launched. The crypto funds out of BVI, which from 2017 has been a massive growth area. We're now seeing the tokenized assets, the tokenized real world assets, again, the mineral side of it, which is an area in which Chinese UBOs have a distinct interest. And do they invest directly, as in direct investment into the mines itself, or do they direct via tokenized funds? It gives them that opportunity. The really large investors, of course, it'll be a direct investment. But perhaps for that mid-level, small-level retail investor that want to get into the Africa market, and I recall just the panel before ours, they were talking about the undervalue of the currency, the undervalue of the equities. I mean, there's a lot of reasons why you'll invest in Africa. The upturn is great. So everybody wants to get into that market. But then again, if you're not the large institutional investor that's going to be putting hundreds of millions into a mine or into telecoms or into a crypto exchange, this gives them the opportunity by means of tokenized assets, by means of tokenized funds, to invest into Africa.
Using a BVI fund structure.
Yeah, using and we're seeing, I mean, we've seen a lot of that in terms of the tokenized assets. Even I mentioned the gold, the diamonds, the real estate, property, even to the extent, I think we're both aware of a product that's being developed at the moment in BVI, through a BVI vehicle, of tokenized investment into uranium. So a very bespoke kind of investment product.
Eric?
Nothing to add on that.
No, just on fund tokenization, it's we've heard a lot of it at this panel and the previous panel, and it's something that's just as more of a regulatory point. The IFCs are currently introducing legislation to promote and enhance the ability of entities, funds to tokenize their offering, to offer digital tokens. And this is happening as we speak. It's an exciting space, and there's a concept of fully tokenized versus token enhanced. We don't have time to get into that now, and I just wanted to very briefly just finish on cybersecurity, which is such a big issue both commercially, even headlines this morning in the news, a huge number of cyber attacks in the UK. But the IFCs are now incorporating specific cybersecurity measures into their legislation in respect to digital assets and tokenization of funds. So cybersecurity is going to be very much a sort of mandatory requirement, putting in robust cybersecurity measures into fund structures. And I just wanted to mention that before we finish off.
Eric?
Nothing
Okay,
to add.
so Tom, Eric, and Jeff, thank you very much for being on this panel, and thank you very much for being a part of the discussion.
Thanks, Liz. Thank you. Thank you.